perspective. Thanks indeed. Sandeep J Shah is with us, Managing Partner at Motilal Oswal Private Wealth Management. Sandeep, great to have you with us here as always. Appreciate your time. I just want a quick market view from you, Sandeep. Up or down, near term? What's your sense?
For now, sideways, of course. But I'm hoping that given the fact that global macros look far more conducive with the dollar index peaking out and US interest rates hopefully peaking out this quarter as well, and the fact that in spite of all the noises about deglobalization, world trade as a percentage of GDP is close to an all-time high, which means that countries are anxiously seeking alternatives to China, including India. Of course, domestically, there's a bit of a minor slowdown in growth in the second half, but with margin pressures abating from next quarter, and if the budget doesn't have any major negative surprises, I think we may slowly grind higher. But there could be some volatility in the near term. And while valuations, of course, are not as cheap as they have been, but we are far cheaper than it was the last time we were at these levels in October 21. And if you were to look at forward earnings, we are at par on a P basis with long-term averages. And while price to book being a more robust indicator, while it's 15% higher than average, ROE is also at 10%. Premium. So if the ROE incline continues upwards, then you would continue to expect to see higher valuations. So I think you should buy into any weakness post-budget, while I would recommend staggering flows over the next 3 to 6 months. In case you see a significant correction post-budget or because of any other reason, I think you should actually go in 50% lump sum and spread the balance. But certainly not the time to get overweight on equities, but obviously the long-term outlook for India remains extremely robust. And there's an interesting point here that the last time the debt levels of the Nifty 500 companies were at these levels, that was in 2005, profits more than tripled over the next 5 years. And this was on the back of total assets also going up 5 times. So, corporate India has never been so significantly deleveraged. Credit growth is back. So I think one should hope that with capex coming back, we should actually growth while it's slowing down this second half. I think it should bounce back next year.
Okay, so keep some powder dry while you deploy some right away. Sandeep, good talking to you after the gap Surabhi here. Given what you just said, let me ask you, if you had 100 rupees, how would you split it between banks, where you're buying growth, and let's say IT, where you're looking for bargains?
So to begin with, I wouldn't put all my money between these two sectors, but I guess let's presume that there's an existing portfolio and there's incremental cash, right? So I would actually be inclined to go 2/3 of the incremental allocation into banks and only 1/3 in IT, because while banks, I think the credit growth remains very strong. Corporate India is deleveraged. You've got while you're seeing that there is some pressure on CASA for some of the banks, the more important point is credit quality, and credit quality remains pristine, and it's likely to remain good for the next couple of years at least. And valuations, while they're no longer cheap of private banks, they're not really expensive either. They're more in line with the long-term averages. So you may not have a significant case for a re-rating, but you've got a significant case for earnings growth driving stock prices of financials. On the other hand, IT, while the worst may be over in terms of margin pressure, while order books are growing, especially for the larger ones, for the mid-tier IT, it's actually been a little mixed bag. It's really dependent on which sectors the mid-tier IT is dependent on. Valuations, of course, are more reasonable now and more on your side. And I think the bigger theme that digitization is only going to gain momentum no matter what. And I think on that premise, I think one would like to buy IT. But IT is something that you would be nibbling away rather than going in for a full-blown out purchase.
Okay, all right. Hi, Sandeep. Good afternoon. Sandeep, you all have been a little bit cautious on the cement pack. That's playing out today. But what would make you all turn your stance? Today the street clearly is spooked by Ultratech's commentary on the pricing front. Some part of the street believes that this may be an overreaction. What would make you all turn your stance on this? Because after all, if India is going to grow, cement consumption is going to be, moving in pace or moving a little bit, growth is going to be a little bit better. So explain that to us.
I don't think there's any problem with the volume story or the demand story at all. As you rightly mentioned, with the real estate sector looking up, with hopefully infrastructure and the government spend on infrastructure, hopefully that picking up as well, you should see demand for cement. But really, it's a question of, at what price do you buy them, and what's the outlook for supply in the medium to longer term. While volume growth, may still be close to double digits, margin pressures continue. And while there may be some marginal sequential decline in margins, I think it's really a question of finding margin of safety in the sector, and B, in terms of the fact that that you're not just buying cement stocks in hopes that there'll be a cartel and there won't be any significant price cutting because of capacity coming up. The market starts pricing in capacity before it starts coming up, right? It's not like you wait for the cement capacity to come on stream and then you see the impact. The stock price is already trying to anticipate that. And, with some big players having entered this, the concerns remain that there could be significant capacity addition. Of course, the skeptics would argue that, it's in everybody's interest to maintain price and margin discipline. But, that's more of a hope. So, I would prefer to be invested in sectors and companies where there is margin of safety, where one doesn't have to hope that certain things play out, but one can actually see the data points supporting one's view.
Sandeep, I wanted to draw your attention to ICICI Bank. The stock is flat despite very strong numbers, and ICICI Bank has gotten re-rated over the last 3 years. Given the lukewarm reaction to what is a very strong quarter, do you think the market is already priced in, the best of the numbers, the re-rating is now behind ICICI Bank, and money could move out of ICICI Bank into other banks, maybe PSU or other private sector banks?
It would seem that, the leader of the banking pack for the last 2-3 years is obviously the re-rating. Bulk of it is over. And I think that incremental re-rating, if any, will be more gradual and dependent on, demonstrating that they can consistently maintain credit quality. One measure of credit quality is always gross NPAs, and that continues to remain higher than, say, the likes of HDFC Bank. And to some extent, we've also seen that banks like HDFC Bank, where the market was concerned perhaps on their technology interface and concerns over FI selling there, that seems to have abated. So I think we're probably already seeing a bit of that already underway. We've clearly seen that PSU banks have bounced back. But obviously, PSU banks, except for perhaps the largest, would primarily remain a tactical call. I mean, it's not a buy and hold. Whereas I think long-term investors can still buy, the leader of the banking pack even today, even if there isn't going to be significant re-rating, because earnings growth is still likely to remain quite strong. So yes, we've already seen the bulk of the re-rating, but depending upon how they demonstrate that their credit quality can be among the best in the banking sector, you could still see marginal scope. And of course, there's always a play of subsidiaries, value getting aggregated there as well.
All right, Sandeep, we'll leave it there. Thank you very much for your time. It's a pleasure, as always, having you with us here on the program. Rima, we were talking about this the company called Nureka, right?
Yeah.
On Friday, it's up another 15%. I think on Friday it was up on circuit. And today it's up another 15%. This is. I was doubtful, but not anymore. This is Dr. Trust. I mean,
okay. But do you know why it's been moving up? What's driving this momentum?
Idea. That is now. I'll have to do some work. But so it listed in 2021. February of 2021. At about 680 or so, went up all the way, I guess, during COVID because of, the demand for these devices. I mean, they make all kinds of, they make,
BP monitors, weighing
everything.
machines.
Yeah. Actually pretty good products. I've used them as well.
Okay.
And it went up all the way from 680 to about 1800 in a couple of months. And from there, it's just been a one-way down journey. And now it's making a bit of a comeback to about 460. Maybe we should invite the management. I think it's a Chandigarh-based company. We should invite the management for a chat at some point. We'll take a quick break here. As always, we'll get you the buy today, sell tomorrow calls with our technical experts on the other side. Stay with us. There is, 20 minutes to go.